Hey everyone, happy Thursday, February 19th. It's a little after 11 a.m. on the West Coast, and it's time for another market update. Well, at the end of last week, mortgage rates had started getting closer to that six number that we'd like to see them drop beneath. As we've talked about, inflation and jobs are the main drivers of the way the Fed's going to vote and what everybody's paying attention to. So this week, we did get inflation going back to last Friday. It's not the PCE report, which is the Fed's favorite form of inflation to look at, but it's the CPI report, also very important, and it also comes out first, so it kind of gives us an idea of what might come out in that PCE number later in the month. So as you can see here, inflation cooled. It was a little bit better than expected. The year over year number dropped to 2.4 in the headline. It was up 0.2% month over month. The core number was up 0.3%, and that brought it down to 2.5%. And as you can see right there in our key headlight, the annual headline CPI fell to an 8-month low. So that's all good news. Like we've talked about, jobs and inflation are the two main things the Fed is paying attention to. And the lower inflation goes, the more likely they are to cut rates, and that's what we want to see. So that was good to see. The next thing we got yesterday, we got the Fed minutes from their meeting a few weeks ago. And again, this is a few weeks old. This is after new data's come out and all that kind of stuff. But basically gives us an idea of what they were talking about at their last meeting. And it was really split. There were some members that thought that the labor market is cooling, inflation's under control, and we should cut more. And there was also members that thought they should pause and inflation might come back and things like that. So it's interesting because a lot of time the Fed voting members are kind of on the same page. But the last few meetings, they've started to split more and more. And that's also heading into, I believe, mid-May is when Jerome Powell, the Fed chair, will be replaced. So it'll be interesting to see how that all pans out once he's gone. See if the different sides take place, as far as the different voting factions and so forth. But Jerome Powell leaving should be good for the camp like which I'm in, which wants the Fed to cut rates and think they're overly restrictive right now. We don't want rates to go down to zero because that could be inflationary. We just want them to go lower than they have right now, which would be better for businesses. Next thing we got new home construction data for the month of December. We haven't looked at this lately, so I wanted to take a look. And this is where we see the permit starts, construction completions. And again, this is for the month of December, so pretty dated right now. Permits were up month over month, 4.3%. Starts were up, construction was down, completions was up. But the year over year numbers is really what I wanted to look at here, where permits down negative 2.2%, starts negative 7.3%, construction down almost 11%, and completions down just slightly. Um, Permits, sometimes people pull permits and don't finish the house, but starts, generally when you start a house, it's going to be finished. So that's probably our best indication of what future houses are going to be available for people to buy. And as you can see, it's down 7.3% year over year. So that means that builders are pulling back a little bit. That means less supply in the future. So, again, if a perfect storm happens and as we expect, rates come down and that increases demand, more people look to buy homes because they have lower rates, and there's less supply out there because the builders are building less homes. That's going to be, that's going to jump prices up. That's basic economics, supply and demand. If there's not enough supply and there's a lot of demand, then prices will go up. So that's just something to keep in mind. If you're a homeowner, that's good news. That means probably that would create appreciation for your home. However, if you're waiting to buy for rates to come down, that's not necessarily the best news because the longer you wait, the higher prices might go. So even if rates come down, you might end up paying more because you waited too long and you have to pay for the higher price. Plus all that equity you could have got now if you bought now and then waited a year and and the market popped, that would have all been your equity instead of somebody else's that you're paying for. So again, good to see month over month numbers up, but still year over year numbers are down, and that shows that builders are retracting a little bit. So next thing we got pending home sales. So this was interesting. This was really regionalized. Let's take a look at this data. Okay, so as you can see here, it was down month over month, 0.8%, down now year over year, 0.4%. And as you can see, though, as we break it down regionally, the South and the Northeast, which got a lot of snow, a lot of bad weather, negative 4.5 and negative 5.7%. Whereas the Midwest and the West, which didn't, the West hasn't had really much bad weather at all, and the Midwest hasn't got as much as the Northeast or South. Those were both up month over month. So basically, in the month of January, the weather had a big part in this, and that makes a lot of sense. If there's a foot or two of snow on the ground, not a lot of people are going out on a Saturday morning to go look at homes. Whereas when the weather's better, people are more likely to go out and look at homes and go view things and possibly buy. So that definitely had an effect on home sales in the month of January. Next thing, initial jobless claims came out today. 206,000 were the new claims. Estimate was about 225,000, so still really low. Again, don't want to see people having to file for unemployment, but the Fed pays attention to this because it's the idea is the more people obviously file for unemployment, the weaker the job market is. So being a lower number is not necessarily good for rates, but it really didn't have much effect on the markets today because partly because these have been really, really low for a while now. Average 30-year conventional. So where does that leave us? Down to 6.05 today. Last week we were at 6.10. Again, would really like to get underneath that six number, but we're right there. So we just need, some positive data, some positive news to go in our favor. We do not want war in Iran. We do not want any sort of oil embargo or oil shutdown. Oil has a big effect on inflation. We don't want to see that. The markets don't like that. So really close to where we need to be. And then going forward, we have tomorrow we have PCE. So we're going to get that other inflation data I spoke about tomorrow. That could be a big market mover if that comes in our favor or worse than expected. That can move the markets and more mortgage rates. A couple weeks later, we're going to get that BLS jobs report. That's going to be the big one on the labor market side of things and how the Fed looks at how things are going because they have their next meeting on March 18th. So just a few weeks away before that meeting, right now the markets are thinking they're not going to cut rates. But again, really lower inflation numbers or bad job numbers could change those numbers pretty quick, and that would probably you make that this 6.05 number drop below that 6% number, which we're all really, really hoping for. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope you guys have a great week. Thanks a lot, guys.